So in the previous episodes, we talked a lot about where to find sustainable growth. But at the end of the day, you need to pick stocks. So how do you go about it?
So we start with sustainability. So this is the universe of stocks that is given to us by the Sustainability and Impact team. This is our SRI best-in-class methodology. This is where we have taken out about 25% of any index, as we would class those as the sustainability laggards. We then focus our attention on the sustainability leaders. We then have to filter that a little bit further. So then we focus on quality. So we are quality investors. We like companies that have good returns. So return on assets, return on invested capital, and sustainable cash flows and strong management teams. We then focus on stock picking. And the way that we do that is by putting together a portfolio of about 43 stocks. This helps us drive very high levels of idiosyncratic return. That really comes out from the portfolio where the top 10 companies account for over 30% of the fund. And you would imagine that the minimum position size is about 1.5%.
So this is the kind of broader background of it. In details, in practice, how do you look at stocks?
Yeah, I think that where we're different is that we classify the stocks. We classify why that stock is going to give us an extra return. All these businesses are quality, they're all sustainable. And so what we're really trying to say is that if you just buy quality, sustainable stocks that are growing, how do you stop paying too much? How do you make sure that you're always getting the best deal in that equity? And so we like to say that 50 to 100% of our portfolio is what we call quality growth at a reasonable price. It means that we're going to make some money, but we're not trying to make huge returns on those equities because, as I've always said, in year 10, they'll have grown so substantially that your growth will go along with theirs. And that's, like I said, currently around 60% of the portfolio. But these are very correlated to equity markets. And if interest rates go up or down, you can actually materially change the value of that company. Whereas up to 25% of what we do is deeply contrarian. So this is what we call a value factor. This is where we're buying something when everyone else doesn't want to own it. And we're doing that at a very advantaged valuation. So the likelihood at that point is that we might make a lot of money on that investment, but we're very unlikely to lose any. And what you'll find is that that's very uncorrelated as an equity return to that principal bucket. The third way we do it, which is totally uncorrelated, is that we buy a quality growth company that's having a problem. Maybe the CEO said something he shouldn't. Maybe the business is currently struggling for a reason. Maybe communication's terrible. Maybe they've done a merger, something. And for that very specific reason, that stock is a little bit more volatile than it should be. And what we're buying is, at that moment, something that's too cheap, but in 3 or 5 years' time will look normal. And all of the money we'll make is in that journey and that pathway to it being normal. Now, when you put all of that together in a fund, it means you should be able to outperform fairly consistently over cycles without taking either too much interest rate risk or taking the risk of a stranded asset.
So we discussed the background of the sustainable growth themes, trends, but at the end of the day, you are picking stocks. So how do you come about finding these investments for us?
Yeah, so the starting point for us is always sustainability. This is the universe of stocks that has been given to us by that Sustainability and Impact team. This is our SRI best-in-class methodology. This is where we focus our attention on all of the sustainability leaders within that universe whilst disregarding the sustainability laggards. That is still a relatively large universe of stocks, so we need to narrow that down a little bit further. We do that by focusing on what we would call quality companies. Now, a quality company to us is a company that has good returns. So think about return on assets or return on invested capital, sustainable and predictable cash flows, strong management teams. Those are the types of things that we look for within businesses. We then go a bit further and we focus our attention on generating our returns through stock picking. So we have a very high focus on idiosyncratic risk. The way that we generate high levels of idiosyncratic risk is by having that concentrated portfolio of 43, 44 stocks, and where we can have the top 10 positions representing over 30% of the total fund.